Cash is the lifeblood of every business, which makes forecasting it an essential skill. Now use this quick guide to cash flow forecasting to help ensure your forecasts are as accurate and reliable as possible. Now despite this, cash flow forecasting still isn't used as often as it should be in many businesses, and is often carried out in ways which make their findings more ambiguous than accurate. Fortunately, there are ways to make cash flow forecasting easier and valuable to get to grips with. So in the business owner's toolbox, the humble cash flow forecast is a well-worn item. Like a builder's spirit level or tape measure, it's pulled out on a regular basis, run over the business to size up the tasks ahead of them. So what is a cash flow forecast? In a nutshell, cash flow forecasts the inflow and outflow of cash in any given period, like next month or financial quarter or year, and the cash surplus or deficit that should be left over at the end of that period. It's essentially a predicted cash book that can act as the basis for calculating how much money, cash, you need month by month to keep your business going. Now this is your working capital, the money you depend on to bridge the gap between paying suppliers and receiving payments. It's the lifeblood of any business. However, cash flow forecasts can also help you make day-to-day decisions. A cash flow forecast can help you assess things like future business overdraft requirements, whether you should increase or decrease customers' credit terms, supplier payment terms to negotiate. If cash flow will be slow, for example, you want more time to pay suppliers. It'll give you and point out actions for you to take if your margins are reduced by unexpected overheads or if sales begin to lower. But perhaps the greatest value of cash flow forecasting comes from its benchmarking qualities, setting the levels at which your business needs to operate in terms of costs, pricing, purchasing, markup, etc. After the period you've forecasted has ended, you can then go back and compare it to the actual results to judge the performance of your business and identify unexpected cash flow issues so you can remain in greater control in the future. This benchmarking process also helps you to identify how seasonal your business is so you can make your stock turnover and marketing strategies more targeted, more specific. When do you use a cash flow forecast? Your cash flow forecast should be completed for each month. Remember to take into account any seasonal aspects of your business as well as cash payment cycle issues. In other words, you may get a lot of business in June but get paid for it in August. If you're in retail, you may buy a large amount of product in September, October, but not get the sales until December, Christmas time. How to build a cash flow forecast. If you have any problems forecasting or understanding your numbers in the forecast, you should definitely talk to your accountant, your business coach, or your business mentor. The structure of a cash flow forecast is very simple. It's just like a cash book. The big difference is under each month, you should also include an expected column as well as an actual column. So you can go back after the period has taken place to benchmark actual and budgeted figures. Now incoming cash, well, that's your cash in categories that's coming in, while outgoing cash, the same, cash that's going out for payments. It's important to tailor the components to your business. So if you find a category of cash payment relative to your business that isn't included, make sure you add it in. The same with payments. What to include? You may well ask what constitutes cash, and that's a good question. For the purposes of a cash flow, you need to look at immediate income and outgoings, as well as the more periodic movements. GST, for example, is something you may need to pay every 2 or 6 months, depending on your cycle, so it can be classed as a cash expense. But things like interests on savings that may have little influence on your cash position on a weekly or monthly basis and can't be assessed quickly to draw funds from, well, they shouldn't be included. While the structure of a cash flow forecast is important, the quality of the data that goes into it is more paramount. If you have previous trading history to go on, the forecasting process is way more easier. You can take reliable data from previous trading periods and increase or decrease the amounts depending on your insights into future markets. But accuracy is the key. Say for example, there's a lot of talk about the economy getting worse or turning a corner. Don't be too quick to make any blanket assumptions. Talk to your customers, your suppliers. Find out the confidence in your sector specifically, and then check your findings with a credible accountant with experience in your industry and let them help you fine-tune the data. The more effort you place into dispelling assumptions now, the more accurate your cash flow forecast will be. Some of the very popular accounting software packages available in New Zealand have their own cash flow module within them that can work with actual results, both past and present, to give very accurate forecasting details, and perhaps you should have a talk to your accountant about those. Next steps. Once you complete your cash flow forecast, you'll either find you're heading towards a cash surplus or a cash deficit position. If it's the latter, don't panic. It's actually a good thing you've spotted this now when you have time to adjust course. If the cash shortfalls you have identified are greater than your overdraft facility, talk to your banker and your accountant. They will need to work with you to help further identify the sources of your cash shortfalls and the solutions that you can use to reduce or eliminate them. Regardless of your findings, you should review your completed cash flow forecasts regularly. Insert actual figures once available and investigate any discrepancies between actual figures and budgeted figures based on your forecasts. It's all about staying in financial control so you know the direction your business is going in, while reducing the likelihood of encountering any unexpected financial bumps on the way. That way, you'll be more profitable and more successful. Hey, thanks again for watching. If you want to know more about starting a business, maybe you want tips on successfully improving your business, start right now, hit that subscribe button. If you like the video, would like to leave me a comment, ask me a question, please do so down below. Give us a thumbs up if you like it. I read and reply to every comment and I'd love to hear from you. Thanks for watching. See you again.